Welcome to the Daily Brief, where I'll go over the highlights for the action in the market for Thursday, December 15th, and then we'll see how things are looking for Friday, December 16th. We had a pretty negative day. A lot of it is being attributed to what happened during the day, and that's true. But overnight, and what was going on in Europe and what's coming out of China, the futures were down about 1%, even before we got to the open. And then after the retail sales report came out, we just tanked right from there. So the market is pretty much taking everything that happened on Thursday as negative and justifying prices going lower. We went down pretty far, pretty fast on a one-day basis, which can be expected with the strong decline that we saw. But we're not really turning oversold yet as far as our charts are concerned, but in the short term, we're seeing a few indications already. And that's not really surprising when we're in a trendless environment. We shoot up or shoot down and we hit overbought or oversold territory pretty quickly. Doesn't mean we have to stop here, but it just means that we might slow down or it might be losing some steam at this point. So let's go back and talk about what happened. Right at the open, we had a gap lower open with prices falling immediately below S1 at 39.57, and we fell below S2 at 39.17, which is kind of strange. We're now battling 3,900. We're below that. Just a couple of days ago, we were battling 4,100 on the upside. So it's a pretty significant down move. As the day went on, prices then broke below 3,900. Without any kind of meaningful bounce. There was a little bit here and there, and I'll show you that when we look at the chart, but it wasn't anything really significant. We closed near the low, not on the low, but near it. We ended up being down 2.49%, almost 2.5% in one day. That's a pretty big move. And volume was still above average. And our technicals, as I've said, have switched more negative. I have some charts to show you that are actually switching back over to a negative stance. So it looks like that scenario that I'll show also from 2006 to 2008, that's now looking more viable again. But we're not really seeing the VIX really climb at this point. So here is the intraday chart where we gapped lower. And as I said, the futures were down 1% overnight, as much as they fluctuated around. They were down a little bit more than 1%, a little bit less, but they were decidedly negative. Well, we gapped down below S1 and immediately went down to S2, kind of camped right a little bit underneath S2 before breaking below that. We then broke 3,900. We set some kind of a base right here, but nothing really meaningful happened. It was just more of a slowdown in the selling rather than building a base before going higher. We did try to go a little bit higher, but it fizzled out quickly and went sideways, and then we closed just a little bit off of the low. So what are some comments that we can make? As I said, the futures were down 1% or so as I was watching them before the market opened. What's being attributed now, the scenario, is that they're concerned about growth with the earnings per share. That maybe the revenues and sales and profits, they're too optimistic going forward. And so we need the market to come down to justify current valuation levels. But that's been there the whole time. And we've been watching that all in 2022, actually longer than that, even with the market being expensive. Well, now they're, at least in Thursday's session, they're deciding to focus more on that. Is that just a one-day focus? Because it's always there. But then when the market really goes down and they can't find anything else that really drove things lower, they go, oh, well, we'll just freak out about the EPS looking forward. So, all right. It was negative from the sense that a lot of things happened in Europe and in China as well, where the European Central Bank, the Bank of England, the Swiss National Bank, the Hong Kong Monetary Authority, they all raised their rates by 50 basis points. And the Norges Bank, which is in Norway, and I think I'm saying that right, they raised their benchmark by 25 basis points. So not only within the US are you seeing rates going up, but this is a global phenomenon that's occurring. China's economy is slowing. They had a number of reports that came out in China, and all of them were weaker than expected. And again, not a real impact on the US other than companies that do business with China. That might impact them, which will ultimately impact their earnings per share on those American companies. The dollar was up on the down day and interest rates fell, which sometimes gives some support to stocks. Well, it didn't do that in Thursday's session. On a short-term basis, we're looking oversold in the territory. Again, doesn't mean we have to stop. We're just getting there. We have the PMOs that are rising. That's one study within our PMO studies, and I do have the chart to show you. We have our stochastics and our Stoch RSI, as well as our Williams percent R. I don't have charts of those, but they're pretty touchy. And with a significant down day like we saw, it's not really surprising that they're showing extreme negative readings right now. On an intermediate term basis, we have the CCI, both on the 14 and on the 20 period. They're getting extreme negative, and that's it for right now. So there's not a real significant oversold condition right now, or at least oversold in negative territory. We still have our yield curves that remain inverted, and that hasn't changed in quite a while. Sentiment, it actually dropped with the down day, so we're back to neutral. We had been more in the greed side or the positive side without being extreme. Well, with the down day, we're back in the neutral area. I think the last reading was 51. And then when we drop below 50, then we're leaning more towards the negative side. The reports that came out, retail sales, a lot weaker than expected, down 0.6%. They expected it to be down 0.1%. The last time we had retail sales, they were up 1.3%. If you take out auto sales, we were still down 0.2%. They expected it to be up 0.2%. And the last time we had this report, they were up 1.2%. Jobless claims were a bit weaker than expected. So that's feeding into this idea that the employment situation is really strong and staying strong and will justify the Fed raising interest rates going forward from here. The claims were in at 211,000. They expected it to be higher at 227,000. The Philadelphia Fed Index, that again, a northeastern area, it came in at minus 13.8. Weaker than the expected minus 10. And the last time we had this, it was down 19.4. Empire State Manufacturing was down, or it was negative 11.2. They expected it to be down minus 1. Last time it was actually up 4.5. Industrial production was down 0.2%, weaker than the 0.1% they expected. Last time it was down 0.1%. Capacity utilization, they expected it to be at 80, and 80 and above means that factories or their capacity is being utilized in a healthy manner. When it drops below 80, that means there are things out there that companies are not using. They can't justify the expense of using equipment or buildings, and so the capacity utilization will drop, and it's at 79.6. The last time it was at 79.9, so just under that 80 level. Business inventories, they were up 0.3%, a little bit less than expected, up 0.4%. The last time we had this, they were up 0.2%. So our trend, it's somewhat positive. It's coming down another day or so, and we're going to cross over with the green line and the red line. And I should have put weakening on here. I negated to change that. We are below 20. Our bias is negative, and our momentum is now negative, where it had been mixed. We were looking better earlier in the week, but as we finish out this week, things are looking quite a bit more negative. Here is the chart that now we can kind of say, maybe we're following this after all. With the real drop, we're way down. The scale's over here on the left. We've dropped below the 3,900 level now, and if we stick to what happened from 2006 to 2008, there'll be some upward movements along this, but for the most part, we could suggest that we might follow this overall price pattern. It's not foregone, but it has been following it so far up to this point. It looked like maybe we were going to break out of that, but now we're looking at this possibly following that pattern. Here's the VIX. It still is pretty low. The VIX hasn't really spiked up yet, but according to this, after this real low period for the VIX and then spiking up, if we do continue to go lower, we'll probably see the VIX really start to climb. Here's the one-day chart showing on an advanced decline ratio basis. We overdid it just from Wednesday to Thursday. And then the rate of change from Wednesday to Thursday is also showing that we went down pretty extreme. Here's the equity put call ratio. I do have updated charts this time. This is a little surprising. The chart that didn't update, we spiked up in Wednesday's session. Well, in Thursday's session, even with the down day, the equity put call ratio really came down. But on a 5-period average, we're starting to go back up again, and we're still really high with this. We're still working off this spike right here. But again, in a healthier environment, we would want to see this 5-day moving average overall continue to decline, and it's just not doing that. Here's our trend showing that we're still going down. I should have said it's a weakening trend because we're below the moving average. See, it was keying off of the green line, which was positive, and since that's coming down, the ADX is going down, and another day or so, and we could see a cross between the green and the red line. So we're still fairly trendless, even though you might be really tempted to say, well, we're in a downtrend. Well, we're just kind of near, we broke through the bottom of this range that we've been in since the early to mid part of November. Could we get a little bounce up out of that and go back into this area for a while? Yeah, that could easily happen. Or are we going to continue to just fall below this level and show more weakness? That's kind of where we're at right now. The BPI, it's starting to come back down. It actually declined with the stock index is going down as well. This is what we're watching for, is that when we spiked up, look at where the S&P was at, and then what happened after that as the BPI continued to fall. And that's happened repeatedly now in 2022. Here's the one chart showing the PMOs that are rising. They're getting extreme negative. We're declining with the buy signals, and we're starting to go lower, and we're still in fairly extreme positive territory with the percent of those stocks in the S&P 500. Their PMO is above 0. But it is starting to decline. The Elder Impulse system, after having 3 green bars, has now gone back negative. And stochastics, the short term, extreme negative, turning down in the intermediate term, and showing some weakness, but not really rolling over yet in the longer term. But remember, all of these charts together, I treat as short term. So even though we have intermediate and long term on this chart, it's subdividing the short term even further. Here's our double and exponential moving averages, where we had been holding above support with the double exponential moving average, and now we're coming down. We're still above this anchored moving average going back to the COVID low. We'll have to see. That's at about 38.80 to 38.81. Can we hold that level? And here's our daily chart where we broke down below the pivot. That's more negative. We're coming down now also to the 50-period moving average. That's still hanging in there for right now. If we come down anymore, is this area going to hold? And are we going to be able to close at or above that level? And then down at the bottom, you see where volume was above average. Here's our moving averages. We still have the 50 down below, but we're breaking through all of the other moving averages that we chart. The 20, which is shorter term, 50 is still hanging in there, at least on a simple moving average. The 100s, we broke below that, and we're really below the 200s. Here's the new highs, new lows. Saw a little bit of an advance in the new lows, and so overall, we're starting to go down with the 5-period and turning down with the 10-period. The STO, or Swindlin Trading Oscillator, I pointed this out in yesterday's video because it was still pointing up. Well, after Thursday's decline, it's turning down now and starting to drop below 0. So that's more negative. The SAR, which had for 2 days now, gave us some positive signals, and the dot's back up on top now. So this has switched back to a negative stance. The vortex indicator, and I don't know why this chart looks so crazy, but it finally crossed. The green and the red were really close to each other. Well, now the red line has crossed, and that's looking more negative. Here's a point and figure. We have a double bottom breakdown. Sounds like a dance or something. But with the circles here, it's showing that we're seeing some weakness as far as the point and figure chart is concerned. Our fib levels, we're breaking through support, and we're just a little bit above this 61.8% retracement now at about 38. It's really hard to read that number. And longer term, we're continuing to be in no man's land. So if we keep falling, we have this double fib level at about the 38.26 level. If we continue to go down, will that 38.26 level hold? The Dow, it's still above these two moving averages, so we're seeing a golden cross there. It could be a fake out. So the Dow was really down over 2.25%. And as long as we stay above these moving averages will continue to show that golden cross. So that is somewhat positive, but it's in danger of losing that, because if we fall below these, then these moving averages are going to turn down. So what's our outlook for Friday? The technicals are negative. Can the 50-period simple moving average hold? That's kind of what we're looking at now. We have other support levels that are in danger of being breached. So we want to just really watch that 50-period, because a lot of investors use that to make decisions. The only economic report coming out is the IHS Market Manufacturing PMI, and then the whole list of geopolitical events. I've highlighted again the earnings because of the EPS freak out right now, that earnings are going to have to be lowered. We'll have to see. Is that just used as an excuse in Thursday's session? It's always there, but is the market fixating on that? They did in Thursday's session. Will that continue? And then we're also debating more about the recession or stagflation, where you have really high interest rates and very low economic growth. But there's still that debate going back and forth. And now that the Fed is doing their things and that's done, and the European banks are doing what they want to do, now folks are really focusing more on the recession debate. All right, our scenarios. You can't really go with the down scenario because our ADX is still well below 20, and our technicals, they are negative. So if you're really adventurous, you might go ahead and pick up on this negative trend, but we're becoming short-term oversold. And if we see follow-through weakness in Friday's session, we're going to see more of those indicators start to suggest that we've gone down too far, too fast. You can't really go with the up scenario anymore, other than the fact that we might be getting a little bit oversold in the short term. Our scenarios, they're showing weakness. Sector rotation, it's breaking down again. Our positive setups that are more moving average based, they're showing weakness as well. Our technicals are really looking a lot more negative. We're losing moving averages, pivots, and fib retracements, and other levels that provide support in this instance. If we go up, they may provide resistance. And then we're going with the sideways because, and again, I should have said the ADX is weakening instead of strengthening. We are still below 20, and we're just barely positive overall. I changed that part, but I didn't change the first part of that sentence. So our conclusion, the S&P is negative overall. In the short term, we're becoming more oversold. We're negative in the intermediate term, and we continue to be negative in the long term because we're below that 200-day simple moving average. And the longer we stay below that, the more danger, or in the longer term, the more damage that does to endanger any repairing that had been happening. So have a great weekend. Thank you very much. And I will prepare a video over the weekend. Again, because I'm still battling this inner ear infection and I'm dizzy and it's really hard for me to look at the screen for extended periods of time, we're not really seeing any changes in our weekly video and in our intermarket analysis videos. So have a great day, and I'll talk to you in the next video.